Understanding suitable business free cash flow investments. Introduction: the power of free cash flow. Free cash flow, FCF, is one of the most important indicators of a business's financial strength. It represents the money a company has after covering essential capital expenditures. This video breaks down how to identify, manage, and invest free cash flow wisely. Whether you're running a logistics company in Mombasa or a tech firm in Berlin, understanding FCF can guide smarter investment choices. What is free cash flow? Free cash flow is the cash left after a business pays for its essential capital needs. It's calculated using this simple formula. FCF equals operating cash flow capital expenditures, CapEx. FCF is what's truly free for use either for growth, reducing debt, or rewarding owners. Example: operating cash flow equals KES 500,000. CapEx equals KES 150,000. FCF equals KES 350,000. Why free cash flow matters. Flexibility: businesses can seize new opportunities without borrowing. Profitability: high FCF shows a company is making more than it spends on core infrastructure. Investor appeal: investors, local or international, value firms with consistent FCF. In Kenya, a retail chain with strong FCF might attract SACCO-backed investment. Globally, FCF drives acquisitions in tech and manufacturing. How to calculate FCF. Start with operating cash flow from the cash flow statement. Deduct capital expenditures. These include costs like vehicles, computers, or building repairs. Keep this calculation routine to understand your cash availability. Example: a construction company in Kizii buys machinery using CapEx and calculates FCF monthly to manage liquidity. Where can free cash flow be invested? Internal growth: reinvest in your operations, upgrading equipment, expanding product lines. Debt repayment: reduce loans to improve financial health. Dividends: share profits with investors or owners. External investments: buy stocks, bonds, or acquire other businesses for expansion. FCF isn't just about saving, it's about growth and smart reinvestment. Reinvesting in the business. Reinvestment helps you grow faster and operate better. Examples include upgrading delivery vans for a Nairobi courier service, digitizing sales systems in a rural agribusiness. Also consider funding research and development to improve your services or introduce new products. In the US, companies like Apple reinvest billions in product design and tech. Paying down debt. Using FCF to pay debt can reduce interest payments and ease financial pressure. Prioritize high-interest loans first, such as short-term overdrafts or supplier credit lines. A Nakuru-based factory might use FCF to pay off a KCB bank loan early, freeing up cash for operations. Globally, firms that reduce debt signal strength and reliability to markets. Paying dividends to shareholders. Dividends provide consistent returns and build loyalty. Decide how much FCF you'll share: 20%, 30%, or a fixed value. Balance is key. Reward shareholders while keeping enough cash for reinvestment. A growing SACCO in Kenya may distribute annual dividends to members while still saving for expansion. Investing outside the business. Use excess FCF to buy financial assets or other companies. Stocks and bonds provide liquidity and earnings, though markets can be volatile. Acquisitions: buying another business can open new markets or bring new customers. For example, a Nairobi-based digital agency might acquire a small content studio to boost capacity. In global markets, Amazon's acquisition of Whole Foods is a famous FCF-backed expansion. Balancing investments and liquidity. Don't invest everything, always protect your cash cushion. Focus on high-priority investments with strong long-term benefits. Keep enough in reserve for daily operations and surprise costs. This balance is what helped many SMEs in Kenya stay afloat during the pandemic. Building a financial safety net. Use a portion of FCF to create an emergency fund. This buffer supports the business during downturns, late customer payments, or price shocks. A Meru-based agribusiness might save 10% of monthly FCF for dry seasons when output drops. In global contexts, airlines maintain reserves to handle rising fuel prices or travel disruptions. Case study, FCF allocation strategy. Total FCF, KES 500,000. 40%, KES 200,000, for upgrading factory equipment. 30%, KES 150,000, for paying off debt. 20%, KES 100,000, in shareholder dividends. 10%, KES 50,000, for emergency reserves. This mix supports growth, stability, and shareholder returns. Kenyan SMEs using this structure remain agile and attractive to investors. Risks of mismanaging free cash flow. Over-investing in non-essential projects can drain your resources. Ignoring debt builds up interest and long-term pressure. Excessive dividends reduce funds needed for growth or emergencies. Always align investments with your goals and capacity. For instance, a hotel in Kisumu that overexpanded without reserves faced cash shortages in the off-season. Before you invest, key considerations. ROI evaluation: will this investment bring measurable returns? Cash flow impact: will you still meet payroll and supplier obligations? Risk tolerance: know how much uncertainty your business can handle. Strategic fit: does the investment align with your long-term vision? This thinking is what differentiates sustainable businesses from short-term ventures. Tools that help manage FCF investments. Use budgeting and forecasting software to model FCF movements. Track all FCF allocations through dashboards or Excel templates. In Kenya, tools like Zoho Books and Sage are widely used by SMEs. Internationally, platforms like QuickBooks, NetSuite, and Xero offer comprehensive financial planning tools. Work with financial consultants for complex investment analysis or strategic planning. Final thoughts: free cash flow as a growth engine. Free cash flow is more than a number, it's the fuel for business success. Invest it wisely in operations, reduce your debts, reward your investors, and build a buffer. Make decisions that align with your goals, whether you're in Machakos or Manchester. Always remember, the smartest businesses don't just earn, they strategically reinvest. Invest with confidence. Free cash flow gives you options, use them wisely. Grow your business, secure your future, and deliver value to those who believe in you. With consistent planning and disciplined action, your business can thrive in any economic environment. Thank you for watching. Plan smart. Invest smarter. Prosper long-term.